Hello everyone. Welcome to Luohan Webinar. I'm your host, Sang Choi. So today we have very great privilege to have Professor Marcin Kacperczyk. Marcin Kacperczyk is a professor of finance at the Imperial College London's Business School. He's also a research fellow at the Center for Economic Policy and Research. In addition, he serves as associate editor of Financial Management, Management Science, Review of Financial Studies, Review of Finance. He's also a former research fellow of National Bureau of Economic Research. Professor Kacperzyk's research focuses mostly on financial markets, financial intermediation, and asset management. He also has written on a broad range of topics such as social norms, short-term debt markets, performance evaluation, inside trading, economic inequality, and many others. He has analyzed various effects of informed trading in finance. His articles have been appeared in top journals, including Econometrica, Journal of Finance, Journal of Financial Economics, Quarterly Journal of Economics, and many other top journals. And also, he's also in many non-academic outlets such as Bloomberg, Financial Times, Forbes, and New York Times, and also many other outlets. So today he's going to talk about his project, Carbon Transition Risk and Net Zero Portfolios. So we're going to have 1 hour of talk. So Marcin, the floor is yours.
Thank you very much, Sango, for this very kind introduction and having me out. Hello, everyone. It's a pleasure to talk about this project. The project is fairly new, but hopefully we're going to have interesting conversation today about what's interesting and what's to do, maybe more than what we've done. So it's a joint work with two of my colleagues working at the London-based asset management company, Fulcrum. So we've been working on this project for a few months now. So I hope to present you some of the interesting results. And the topic fits in within a slightly broader agenda that I have been interested in over the last couple of years, which essentially relates to the notion of climate-related risks and how to think the role of finance in solving the climate problem. So title of the paper today is Carbon Transition Risk and Net Zero Portfolios. So just going straight into the motivation. So essentially, I'm sure for this audience, I don't need to over-motivate this topic too much, but I think the last few years have changed a little bit the perspective that people have on the natural science and what's happening actually with the climate. Many of us tend to believe that actually there are some visible changes, and if we continue in the way that we have done in the past in terms of economic output, there is actually a potential risk that temperatures may become too high and the livelihood on Earth, it may actually be difficult. So as a result, what I think the last few years have kind of observed, it's a lot of shift in the way how people want to think about economies and specifically the climate problem, in a way that now more and more people are very much concerned about this issue and try to see what it is that we can do to actually solve this climate problem. And the climate problem at the first kind of order of approximation is really about the amount of emissions that we globally produce. And physically or scientifically, we know that these emissions are linked to the changes in temperatures. So if we want to control the temperatures, we should control emissions. So what this has kind of generated is a movement that, broadly speaking, is called decarbonization. And decarbonization has been manifested by many players. The governments have started this movement in around the Paris Agreement time of 2015. But since then, we have also observed a lot of other players, including the companies and other stakeholders, to kind of commit to similar decarbonization paths. So essentially, when we think about decarbonization, we are thinking of some kind of behavior in which we are going to reduce emissions. And of course, you can think of many different paths in which this can happen. And the left side of the slide is supposed to show you a number of these different paths that you could take. But many of these paths have kind of a common denominator. So scientists tend to tell us that we should try to stay within 1.5 to 2 degrees of increase in temperature relative to the pre-industrial era. So where we are right now in terms of emissions that are produced globally is we produce roughly 40 gigatons of emissions per year. If we want to maintain the temperature within that bound that I specified, we should actually aim to go to zero by mid of the century. So this idea of moving from something which is quite emission intensive to something which actually does not produce emissions is the kind of shift that we are talking about in the way how the society wants to move. And in this paper and in many of the other papers I have written on the topic, we kind of gonna assume that this is not questionable, that the society wants to solve the climate problem. The more interesting question for us as economists is how to do it and what are the potential costs and benefits of doing this. So one of the interesting kind of ideas that is related to this shift from something that we call the brown equilibrium, which is where we are right now, to something that we call the green equilibrium, is that this transition does not happen in the absence of cost and benefits. And people tend to talk about this kind of process as being something that we call a transition risk. So transition risk is going to affect companies because they need to adjust their production kind of ways in which they emit, and it's going to also affect investors because investors commit capital. And it's going to affect almost everyone. And the question that I think people try to answer in economics is how high this transition risk is. How can we measure transition risk? What are the kind of ways to kind of benchmark what it actually means? So just to give you some perspective on this question, as I said, I have been working on this topic for some time with someone who is involved with your academy, Patrick Bolton. We have written a number of projects. So in the kind of our perspective of transition risk, what we have tried to think about was to think of the framework in which we can think of individual firm level emissions and try to think of them as a proxy for the scale of this risk. So essentially the intuition we had in this line of research that we have written with Patrick was that higher emissions are likely gonna lead to more risk because you all at the end need to go to zero emissions. So the higher is that basically amount that you need to reduce, potentially is the higher the risk that you face. So important in that is that that risk is kind of based on the backward-looking information. We observe emissions from the past, but we are talking about the risk that is naturally forward-looking because we are talking about the risk that happens in the future. So that's one way to think about it. Another way to think about it is to kind of merge what Alibaba does, so AI kind of technologies with the climate science, and try to think of some kind of textual analysis in which we can think about how companies essentially think about the transition risk. So here, one of these papers that is fairly interesting is the paper by Zach Sautner and co-authors, also in the Journal of Finance this year, where essentially they look at textual analysis of corporate disclosures, and they try to measure how much companies talk about this issue of transition risk in their corporate reports. So of course, if you think about that, that's also based on the past data in a sense that we need to rely on what companies have kind of done. They may, of course, talk about forward-looking information as well. And it is potentially subject to greenwashing in a sense that companies may say whatever they want, and there is no direct verification whether that particular aspect of their behavior is verifiable or not. So the bottom line of these two approaches is that both of them to some extent rely on the backward-looking data. And at some level, especially the second approach, is a little bit divorced from the climate science. And in reality, what I think what we need is the frameworks which are more scientifically motivated and they are more forward-looking. So that's kind of where this paper today is supposed to add to that debate. We are trying to propose the framework in which you could actually benchmark this climate or carbon transition risk by thinking about forward-looking decisions that are motivated by the climate science. And the context in which we are going to do it is something that we call net zero portfolios. So essentially, net zero portfolios are motivated by the picture that I have shown you in the beginning. So we know that science tells us what should be our decarbonization paths if we want to maintain the temperatures. So now think of this kind of path that scientists are telling us as the way to decarbonize the economy and try to extrapolate it to the carbon footprint of portfolios held by institutional or some kind of investors. So you can think of it as some kind of mimicking trajectory in which the carbon footprint of your portfolio is gonna look very similar to the decarbonization path that scientists are going to tell us in order to maintain the temperature. So this idea of trying to mimic this science-based paths is essentially what's behind this net zero portfolios. Of course, the first thing to realize is that this is not a promise that we are gonna decarbonize the economy. It's just the economic framework in which you can hope that companies are gonna respond to the pressure. So the idea is gonna be that if you provide this kind of decarbonization framework to your portfolio, some companies are gonna be excluded from your portfolio. And of course, that may have some kind of impact on the cost of capital of these companies and the engagement with investors. So just to tell you about this net zero portfolio initiative, it turns out that this is gaining a lot of traction. There are a lot of institutions that currently are discussing to kind of follow this net zero principles. And I've listed here a few for you so that you get a sense of how large of an initiative we are talking about. So if you just add up the numbers I put here, and there is a little bit of double counting because some institutions could be part of more than one initiative, we are talking about more than $100 trillion of assets that are covered by this kind of initiative. So just so that you get a sense, that does not necessarily imply that $100 trillion currently is already divesting of these assets. It's just something that puts pressure. So what this means is basically is that there are two kinds of forces operating at the same time, the divestment today and the expected divestment in the future. So that's, in a sense, how we are going to be thinking about the forward-looking risk from the perspective of these net zero portfolios. So now, what is specifically that we are going to do in this paper? So we are going to take this idea of the net zero portfolios and basically this pressure that I have characterized in terms of decarbonization of the portfolio, and we are going to translate that into a specific measure, a measure that we are going to call a distance to exit, or I'm going to use this acronym DTE for the rest of my talk. So what's the idea of this DTE? Essentially, the idea is that if we think of the carbon budget of institutional portfolio, as the carbon budget becomes stricter and stricter, fewer and fewer companies are potentially going to fit into the portfolio. So at some point, companies are going to be left out from this net zero portfolios. And that's essentially what we think is going to create a pressure for them, because being owned by, say, large institutional investor potentially is important, or it can also, of course, be important for reputational reasons, etc. So we are going to try to measure the distance in time, how long it is going to take for companies to be actually excluded from this net zero portfolios. And this distance in years is going to be exactly the metric of DTE that we are going to apply to every single company. So if you think about this metric, what's nice about this metric is that it's totally forward-looking. We are looking at the decisions that are going to happen in the future, not the decisions that already have happened in the past. So from the perspective of the risk kind of measurement, it's a very attractive measure because it tells you what it is that can be applied in terms of the pressure from investors rather than what has already happened in terms of the pressure from investors. And finally, what's interesting about this framework is that it's dynamic in nature. So in a sense, there are many layers by which you can think about the dynamics. This carbon budget can be changing because emissions can be changing over time. And the companies themselves can be changing their emissions so they can kind of interact with each other in the way how they are going to be part of this net zero portfolios or not. So using this whole framework of DTE that I have outlined, and I will explain in more detail in a moment how we do it specifically, we will try to understand to what extent equity prices globally already reflect the variation in this DTE. So in other words, we are going to be looking for some kind of premium for the variation in this pressure due to the net zero portfolios. So that's going to be the second part of the paper, where I will try to illustrate to you the link between DTEs and valuations of companies.
So I have a quick question.
Yes, of course.
Yeah, just a quick question. So the DTE, the distance to exit, yeah, I guess that's definitely related to what firms gonna do in the future, right? How much they're gonna reduce. So yes. Then obviously you need to measure kind of expect how firms gonna do based on what they're saying.
Mm-hmm.
So
Mm-hmm.
how will it be different from those kind of the previous methodology you just explained?
Mm-hmm.
You're gonna measure, you're gonna estimate what they're gonna do based on some more data-driven methodology?
Excellent. So part of this, as you are right, Sanwoo, is going to be about what companies do in the future. So this is going to be one of the challenges. How are you going to essentially predict the future behavior? And we are going to actually try to do that. So contrary to the studies like mine with Patrick, where we look at the past data, like emission data, we are going to try to actually use the past data to predict the future information on what companies potentially may do in terms of their decarbonization efforts. So I will show you a number of different ways in which you can think about this decarbonization efforts. And at that point, we are going to discuss how good they are in terms of predictability. But related to your question, what's also going to be important is that this is not just about what your emissions are going to be, but also how you interact with this budget constraints, right? Because remember, in the whole methodology, what's also relevant is how much emissions we allow in total at each point in time for the portfolio to hold. So that is an interaction between what your emissions are going to be, what peers' emissions are going to be, and how tight that budget is going to be in the future. So there is a little bit more to it than just to say, I want to estimate what the company's emissions are going to be in the future. So that's kind of the idea behind this DT. Okay. But again, we can maybe come back to it when I get a little bit more specific, because I will be more specific. So far, I'm just giving you a little bit of an outline of where I'm going with this. And in a moment, I will show you specific kind of data in which you will be able to see what's really happening there. So one more slide on a little bit of an economics. Since this is an economic seminar, I want you to get a little bit more kind of foundation for why we think it's potentially useful for studying valuations of companies. So clearly, one of the lines of research that we have taken with respect to climate is this idea of institutional pressure. And you can think of it in two ways. One of them is divestment. So this is just saying we are not going to hold certain companies. And if we don't hold these companies in a large enough scale, there could be potentially pricing effects. That's the story of the Merton model. I have a paper called Price of Sin with Harrison Hong from 2009, where we have tried to see to what extent this kind of divestment pressures matter. Alternatively, you could think of engagement. You can think of institutional investors like Vanguard or BlackRock that basically go to companies and try to enforce a particular change in terms of their emissions. So that's another way in which you can actually relate to the risk of the companies. And to be honest with you, there is quite a lot of debate in the literature at the moment that tries to argue which of these channels is in some sense better. Is the divestment a better channel that institutions should follow? Is it engagement? More recently, probably people lean a little bit more towards engagement versus divestment. So how is it that we are going to do it differently? So one thing that we are going to acknowledge in our paper is that divestment is not necessarily only an exposed phenomenon. So the literature that we are referring to is always thinking of divestment as something that is already happening. So think of the portfolio that is basically decarbonizing today. Think of not holding companies that, for example, are related to some kind of sinful activities. But what our framework actually introduces is a notion of expected divestment, because we are giving you the whole path of where this decarbonization of your portfolio is going to go into the mid-century. You can basically think not only about what's happening now, but also what's going to happen in the future. So this is a new kind of idea, economically speaking, called expected divestment. And related to that, what becomes interesting is that as you announce to companies that you are going to divest of them in the future, you can think of this announcement as a form of engagement. So in this regard, what this framework introduces is a very interesting interaction between divestment and engagement, which is very different than what we typically do in economics, because in economics, people have studied this phenomena as being independent of each other. What we are trying to say in this project is that they could be actually correlated in a sense that divestment may interact with engagement, and you have kind of the synergy of the two happening at the same time. So that's the kind of another layer that is important. And thirdly, notice that the idea of divestment in this setting is not just the idea of your own company decarbonizing, but also what other companies are going to do. So in this regard, there are some kind of general equilibrium effects where companies are going to kind of go into a race where one company may think about other companies' actions, and that jointly is going to determine which one is going to be divested more promptly than another one. And as a kind of overarching framework, what's attractive about what I am hopefully going to show you today is that it's also all cast in the climate science, because notice that these curves that essentially predict the decarbonization paths for portfolios are motivated by climate science. So in this regard, if climate science changes, that could directly feed back to the portfolio decisions. So that's the way in which we want to link directly risk to evidence from physics, rather than just some kind of loose notion of what we think is good or what's bad in terms of the climate change. Okay, so that's kind of the more or less the overarching framework. If there are any questions, I'm happy to answer. If not, I will go to details of everything I have just said. Sounds good. So I assume that we can revisit a little bit more if there is later, if there is some extra question. So let me start with the following. The starting point for anything we are going to do is going to be the climate science. So as I told you, we are going to be motivated by scientists who tell us how is it that we should be thinking about the carbon emissions globally if we want to sustain our temperatures within a certain bound. And as you know, as I mentioned, there are many different scenarios that scientists tell us in terms of what can happen with temperatures, etc. And of course, we are not able to analyze all of them at once. So instead, we are going to focus on just one scenario, admittedly, the one that is quite popular among scientists and also policymakers, which is the scenario of what we call 1.5 Celsius increase with 83% probability. So that's one basically scenario path that we are focusing on to illustrate our ideas. And under this specific scenario, what scientists tell us is that as of beginning of 2021, I'm using past data to illustrate the idea, we could emit a maximum of 260.7 gigatons of CO2 equivalent. So that's how much the society can produce in total, not per year, over the remaining time period. That's how much we could produce. So now you can think of the following thought experiment. Suppose that I look at the end of 2020, so this is just at that time when I'm making that projection, and I look at how much the world has produced globally in that year. I could find out from here is the Sources Global Carbon Project, that the society has produced 39.3 gigaton of CO2. So think of the following experiment. Suppose that for the next future, we are going to maintain that level of emissions every year, constant. Suppose we don't decarbonize, we don't increase emissions. Given that we have 260.7 to spend, it would take 6.6 years to deplete the whole budget. That's essentially the kind of metric of risk from the science perspective. That's how we as a society can actually progress if we want to maintain that particular level of temperature. So 6.6 years is just that constant kind of rate emissions if we want to fit within that specific budget. So now think of the same kind of intuition applied to a portfolio. So we are going to think of the same kind of multiplier 6.6 and try to think of it from the perspective of institutional investors who hold companies that actually are producing emissions. So of course, the first thing you need to realize is that portfolios held by institutions are not necessarily equal in size to the whole economy, because institutional investors only hold a subset of the economic activity. They don't hold every single asset that produces emissions. So the starting point for this exercise is to restrict the universe of assets to the ones that you can actually observe. And that universe is going to be determined by this data set called true cost. I'm sure you are familiar with true cost. That's the data on firm level emissions. So we are going to take all information of global companies for which we have emission data. Now we take the scope 1, 2, and 3 emissions of all those companies, and we add them together for that year 2020. So if you do that exercise, you will find out that that number is 24.8 gigaton of CO2. And now what we are going to say is institutions are going to face exactly the same risk as the society. So we are going to take exactly the same multiplier of 6.6 and extrapolate how much total budget we would have for that 6.6 years if we continued the same level of emissions in that period of time. So 6.6 times 24.8 gives you a budget of 163.7 gigaton of CO2. That's how much institutional investors can have in their portfolios for the future. That's the total budget, the cumulated budget. And now the question that becomes interesting is, given that budget, how can I select companies such that I can maintain this budget for the future? That's this idea of the net zero portfolio. So let me show you a graphical representation of that. This picture shows you how the scientists think of the problem. So among others, I'm plotting this path that I've already described, starting in 2021 with 39.3 gigatons of emissions. If we want to maintain 1.5 Celsius temperature, the brown path tells you how you would decarbonize this economy at a constant rate of 18.1%. Now I'm going to take the same idea and apply it to a portfolio, and that's my portfolio. In 2021, I allow myself to hold companies with the carbon footprint of 24.8 gigatons, and applying the same kind of constant rate decarbonization, you can see that progressively the budget becomes tighter and tighter. So that's the idea in which companies are going to progressively find it more and more difficult to fit into this portfolio unless they reduce their emissions. That's the pressure that institutions are going to put on the companies, because they're going to pre-announce, look, unless you change something, this is your kind of exit path from that particular institutional portfolio. And you can see that at the end, this becomes extremely tight. You start getting closer to zero. We don't fix it exactly at zero so that there is at least some residual emission, but still it's pretty close to zero where we arrive at the end of 2050. So now let me tell you how this leads to this distance to exit measure that I have mentioned. So we start with our projections of the year-by-year carbon budget of absolute emissions. And then we are going to impose a certain decarbonization path. One that I have shown you before is an example of that. And now we want to decide how we are going to choose companies to actually add into this portfolio. So it turns out that you can have different ways in which you are going to think of that. Just to put ideas so that you get an intuition, and I'm going to relax it in a moment, I'm just going to start from a very simple rule. Let's sort companies by their total emissions from worst to best, assuming that they don't change their emissions into the future. So think about it like whatever your emissions are today are going to be for the next years until 2050. And then every time apply this budget to see which companies are going to fit in within the budget, which of course means that a subset of companies potentially could be restricted from this portfolio. They are not going to be part of that portfolio. And how you are going to be basically divested of that portfolio is going to determine your distance to exit, how many years it takes for you to be excluded from that portfolio. So here is an example to think about it. Again, we are just in 1 year, and just to illustrate the idea, this is end of 2020, as I told you. We are taking the global set of companies in Trucost. So you see I have more than 14,000 companies here, and I'm sorting them in terms of their emissions in a decreasing order. So notice that the first company here has the highest emissions. The last company in the list has the lowest emissions of all. And then I'm basically looking at the budget for a given year. Here, the first budget in 2021 is 20.3 gigatons of emissions. And I'm trying to see how many companies would fit cumulatively inside this budget. So you see that 24 companies are going to be outside of the budget that I have. And that essentially means that they would be excluded from this portfolio right away. And their DT is equal to 0. Now notice as I go forward, the budget is shrinking. So 2022 budget is already 16.6 gigaton. And remember, I assume that the emissions for everyone are the same and constant. So I don't need to resort anything. All that I'm doing is I'm applying a tighter constraint now. As such, more companies are going to be excluded. So now the subset of new companies are going to get a DT equals to 1. And notice that I can keep doing it until 2050. I just showed you a couple of years here, but essentially I repeat this exercise until the last year, where the companies that never get excluded get the maximum possible DTE equal to 30. So in this exercise, every company is going to have its own DTE. That's just 2020. Now you can think of repeating the same exercise for many years, not just 2020, but any date for which I have emission information. So in my case, it is from 2005 until 2020. So just a company I want to focus on is Apple. Notice that in this picture, Apple has been excluded in 2024 and its DTE was free. So now I want to show you how Apple looks like over the multiple periods that I have analyzed the data. So not surprisingly, what you can find is that back in time, Apple had a longer DTE, which essentially meant it was less risky from the perspective of getting excluded. But as the time has run out, that budget gets tighter and tighter, and that of course reduces the DTE of Apple, and that makes Apple essentially more risky from the perspective of being excluded from these institutional portfolios. So that's one simple kind of relationship you can get from the data. But of course, what also affects Apple's DTE is not only the fact that budget has shrunk, but also how Apple has managed its own emissions and how other companies have managed their emissions. And you can see that relatively speaking, Apple has been becoming progressively worse and worse, even though in the last few years, the DTE has been kind of stabilized at 3. So there are many kind of forces interacting with each other that determine what the DTE of Apple would be. So that's kind of the basic paradigm by which we are going to construct the DTE for every single company in our data. So now let me tell you what it is that you can do more with that. And this is going to be related to your comment, Sanwo, in a direct way. So the first kind of immediate impression you may have from what I have shown you so far is the idea companies are from different industries, and the potential to emit, of course, is different for the company that is a financial company versus the company that is a coal mine company versus the company which is, I don't know, IT company. So as such, what makes more sense is to actually neutralize companies relative to their industries. So this is the first thing we are going to do. We are going to think of sorting based on the within industry kind of adjusted emissions. So that's the kind of exercise I want to do on that Apple that I have shown you. And the industry we are going to focus on is the GIC 4-digit industry. So that's just to give us enough variation in the data such that this exercise is meaningful. So this is now to compare for you how the DTE of Apple looks like under the previous scenario, which is the top panel, and under the new scenario, which is just for industry. And notice immediately something very interesting. The DTE for Apple goes lower, which essentially means that Apple becomes riskier if you take into consideration its own peers, the peers within the industry. So now there is actually a time in 2015, you can see where Apple is already excluded from this net zero portfolio. So you could argue that one of the reasons why this is happening is that on a best-in-class basis, Apple is actually not doing as well relative to its peers. Maybe Google's, Amazon's, and whoever is in that industry is actually decarbonizing better than Apple itself. Of course, what's different here is that the budget is specified on the absolute emissions, whereas we are sorting on the industry emissions. So that kind of ranking and fitting within the budget is a bit less efficient because the two metrics are not exactly the same. But nevertheless, I think it is fair to say that Apple is doing worse relative to what it was doing on the unadjusted basis. So this is one way in which you can kind of generalize this framework. Another way you can think about it is, question, Salmo.
One question. Well, it's hard to understand why you're doing industry adjustment because, in that way, for example, if you're doing relatively well on the chemical petrol industry, maybe your DTE would be higher than some maybe relatively poor carbon emission company in the recycling industry, right?
That's correct. Yes. So in some sense, this industry adjustment gives you a little bit of the extra points for the fact that you were born in a wrong kind of neighborhood. I agree with you that it's not necessarily the right way to think about it, because you may think, why am I giving you a benefit of the fact that you are in a kind of more polluting industry? But essentially, think from that slightly different perspective, Sunwood. Suppose that we as social planners want to maintain the more balanced economy. So the idea is that I want to kind of have a broad industrial representation of companies. So rather than just decarbonizing by killing a handful of industries, which you could, you want to think of any decarbonization that kind of maintains the diversification aspect of the economy, but prunes the worst kind of performance within each of these industries. So this is a little bit of a risk management kind of story, right? I mean, yes, you could do what you suggested. I could just get rid of some industries and keep some others overweighted. But alternatively, I could be thinking from the perspective of broader representation of industries rather than just getting rid of them. Just as a specific example, think of something like a cement industry. We all would agree that cement industry is a very high carbon intensive kind of industry. It's a lot of pollution that cement comes with. So now imagine that most of the cement companies are actually high polluters. And by means of sorting them on just unadjusted emissions, you get rid of the whole industry called cement, just as an example. We would agree that that may not be the best strategy from the economic kind of viability, because we as a society may still need cement. So just immediately getting rid of the whole cement sector may be less desirable than trying to get rid of the worst cement companies rather than all cement companies. So that's kind of the intuition that I would apply to that specific idea.
Sure. To follow up on this question, could I ask how strong is the industry factor?
Yeah, so in general, for the DTE, clearly it matters. But of course, Randy, as you can imagine, some companies are going to benefit from that. Some of them are going to be hurt, right? So notice that everything is kind of mean zero, right? Because we are essentially demeaning your emissions within the industry. So in this regard, there will always be losers and winners in that strategy. From the asset price perspective, I'm going to show you that later. It is not a strong component as you would think. So it's not what drives the variation. There is a within industry variation that matters, not just the cross-industry variation.
Okay, thanks.
Yeah. All right. So along the same lines, I think it's a very good set of questions you guys have asked. You could think about a slightly different idea. So far, I have focused on sorting companies based on their current emissions, whether they are industry adjusted or not. They speak about where emissions are now. But you could ask the following question. What if there are companies that actually are going to decarbonize faster in the future, but they have not yet done that? Maybe they have technology, so maybe they have kind of principles that, say, in 5-10 years are going to make them better. If I get rid of these companies today, again, this may not be necessarily the best way to implement this framework. So to kind of speak to that possibility, as a second generalization, we are looking at a framework in which we will try to forecast the emissions of companies into the future. In fact, we are going to forecast them up to 2050. So this is a pretty serious exercise from the perspective how difficult it is. And I want to say it at the outset, this is not what the paper is about per se, right? Of course, we are trying to forecast emissions, but we acknowledge the fact that these forecasts are not like perfect. So there will be some issue of noise. But nevertheless, let me show you what it is that we do here. So we are going to kind of embrace two ideas. We're going to think of forecast in terms of what companies commit to do in the future. So this is going to be based on the CDP commitments that they make, and based on what companies have done in the recent past. So this is a little bit like extrapolating the previous behavior that you've exhibited in terms of your decarbonization effort. And we are going to construct the future emissions as a weighted average of these two basically signals. How much you commit to decarbonize versus what you have done in the recent past. And of course, many companies don't make any commitments, in which case you would only rely on point B, which is the past trend. But for those which do actually make commitments, there is a weighting scheme that is going to be applied depending on how credible your commitments are. So I'm not going to spend time describing to you these weighting schemes. In the paper, we describe it in detail, but be kind of aware that we are trying to also condition on how credible these commitments are in the way how we weight point A versus point B. And from that exercise, we are going to essentially extrapolate the future emissions of the companies until 2050. So this is now result for Apple. from this kind of exercise. Now, rather than looking at past emissions, we are looking at future emissions. And this is done again on the unadjusted basis, I believe. And notice an interesting story. First of all, of course, the DTE for APU reduces relative to what it was on an unadjusted basis. But if you think of the previous exercise where I showed you the industry adjustment, and I showed you that at certain point in time, APU got to DTE equal to 0, now you can see that actually APU never gets to 0, at least within the time frame that we consider. So you could argue that there is something inside APU that makes them look better than just the pure sorting on the industry adjusted basis. And you can see that there is a little bit of a change around 2013, 2014. APU has been declining its DTE until 2012, and out of a sudden DTE goes up, and then again it starts going down. But essentially, if you look at the data, you would notice that around that time, APU started communicating some of its own commitments. So there is a value to actually self-declared motivating reasons to actually decarbonize in the future. So we try to incorporate that information into our DTE calculation. And then the final thing to kind of think about in terms of adjusting this DTE, you can also think of information other than emissions. So far, I have told you about either emissions today or emissions in the future. But there is a bunch of other information that potentially matters for corporate decarbonization. One is the difference between emission level and intensity. So some people have argued that maybe we should be looking at how efficiently we are producing emissions. So that's what emission intensity is supposed to measure. Then there is, of course, an issue of growth rate, how fast you are growing your emissions. And then there is a lot of information that we could broadly call as soft information. So you can think about corporate policies, you can think about targets that companies have, some kind of greenwashing activity, and maybe on a slightly more hard data, amount of patenting in a green space, etc. So we are going to take all this information and we are going to combine it into an aggregate score. The score that we are going to call an ambition score. Ambition score, as you can see, is a weighted average of these three pillars: historical emissions data, historical intensity data, and all this forward-looking data. The weights that I have put here are fairly subjective. We could do more in terms of optimizing these weights, which give you the highest maybe decarbonization predictions. This is just a simple exercise to illustrate the point, how this looks like if we actually take into consideration a broader kind of set of information than just emissions. And the upshot of that is that companies which have basically lower ambition are going to have a higher score. So higher ambition score means actually worse kind of performance. So this is how we would construct the score for APU. And again, this is just for 1 year, 2020. You can see that there is a lot of information, emissions, and all this soft information. Importantly, what we do is we convert all of this information into numerical value. So of course, emission levels and the intensities are the same, but then anything that is Boolean is basically converted into some kind of binary variable. And then we're also looking at this other information. And then as the next step, we are actually standardizing this by taking the industry adjusted value and also putting it on a 0-1 normal distribution scale. So everything in the last column is the 0-1 normally distributed variable. And then given the weights that we have, we are basically weighting this information together into an aggregate score. So in this particular year, APU has a score of 31.47. If you want a kind of rough interpretation of that number, it's not precise, but roughly, that tells you that this is a percentile of APU relative to everyone else in that year in terms of its ambition. 31st percentile of the distribution is roughly where APU is in this particular distribution. So now, using that ambition score, you can again come back to the DTE calculation and notice that now, based on how ambitious APU is in terms of decarbonization, that actually makes it worse on the DTE metric. Notice that now, very quickly, APU kind of goes down towards 0, which tells you that relative to its peers, its efforts to decarbonize are not as serious as the efforts of their peers. So in this regard, ambition-wise, APU is not decarbonizing in the best possible way. And let me skip this slide. and just say the following. So you could create this basically information for every company, these different flavors that I have presented to you. So that kind of brings us to the second type of question that we want to have is, how does this all square in the aggregate in terms of what is happening in these portfolios and in terms of how they are priced by investors? So the first thing I want to show you is something that you may be curious about, which is the anatomy of these DTEs. How is it that these portfolios of companies look like on the kind of, let's say, representation of the economy? So what this picture shows you, let me just focus on the left picture, which looks at the DTEs based on industry-adjusted emissions. The weights that the dots that you see here are basically showing you the percentage weight of each sector in the portfolio. So the black dots are the universe of stocks that we consider. These are the true cost universe. So you can see, for example, that software and services is the highest weighted basically industry in this true cost universe. And then what the other colors are showing you is what this weight would be under the scenario of companies which are just held with certain properties. So the orange dots are the ones where the companies that are held have DTE that is at least 5. The blue ones are the DTE that are at least 15. And the green one are the companies that never get excluded. Remember, the maximum DTE in 2020 was 30. And as you can see, through this picture, clearly there is some deviation of the dots from the black benchmark as you increase your DTE, which is not surprising because the more companies you exclude, the more you are going to deviate from the benchmark. But notice that if I go to something like orange picture or even the blue picture, these deviations are not enormous. So in other words, we can decarbonize these portfolios without necessarily deviating a lot from what the benchmark is to start with. Of course, in the extreme case where we literally get rid of all of these companies with DTE less than 30, that there are some industries which essentially would never be helped. But again, keep in mind that this exercise is a little bit unfair in a sense that we are looking at weights conditional on the fact that these companies are not going to do anything, say, 30 years later. So that's kind of one way to keep it in mind. Another way to see this exercise is to think through the number of stocks that would be held in this portfolio. So again, the black dots in the left picture show you how many stocks you would have in each sector if you just held the true cost universe. And then similarly, the orange, blue, and green pictures tell you this other basically variance. And again, notice that especially in the middle kind of cases, the number of stocks that you hold in these DTE portfolios are actually pretty sizable. So it's not like we are literally removing 95% of companies from the universe and we are left with a handful of companies that we can keep to maintain basically this net zero portfolio exposure, which is good because it tells you that from the perspective of some kind of transaction cost or illiquidity, we are actually not doing as poorly. And just to convince you that actually these portfolios are actually sensible, this is a picture where I now compare companies in terms of their characteristics. So notice that in terms of something like the size of the company, we are not deviating too much from the benchmark. So this is just a percentage deviation from the true cost. Just essentially, these companies are as exposed to size as the true cost universe. Similarly, leverage, similarly, market to book, a little bit more deviation in terms of momentum and ROE. But importantly, holding all these deviations in the top low, notice that I'm able to decarbonize quite a lot of the portfolio. Even the orange one already tells you that I decarbonize more than 50% of my portfolio. So in other words, this is one of these kind of nice graphs, which tells you the cost of doing it in terms of losing my diversification or some kind of tracking error is pretty small, but the benefit in terms of decarbonizing the portfolio is pretty large. So that trade-off kind of is very symptomatic of this net zero portfolio, and it's quite attractive way to assess the quality of this exercise. Okay, so a couple of more pictures. Here is the picture where I show you how these different variants of DTE correlate with each other and also correlate with emissions. So not surprisingly, we would expect that emissions correlate with these DTEs. And this is what you see, the correlation is negative because higher DTE generally means a better company. But also notice that these correlations are not 1. They're somewhere in between 0.2 and 0.3, or 0.4. So it's not like we are measuring exactly the same information in the data. And even more so when you look at the ambition score, that correlation is even smaller. So that tells you that the DTE is not just a function of the score itself, but it's more about the interaction between the score, the budget, and what everyone else is doing in this particular universe. Similarly, in the bottom picture, you can see the time series variation. Not surprisingly, these DTEs are going down over time, but they also go down at slightly different levels, which tells you that different DTEs put different pressure on these companies. And the stock universe, you see, it's actually large in the way how we draw for these particular portfolios. So in the last 10 minutes, what I wanted to show you now is how does it look like from the perspective of valuations of these companies? To what extent do we observe that the framework that I have introduced to you is actually already reflected in the prices of these assets? And I'm looking at equity values. So what are we going to do here? We are going to kind of implement a standard characteristic-based approach where we are going to look at cross-section of stock returns of companies. This is going to be a monthly data where the dependent variable is going to be the next month stock return. And we are going to regress these monthly stock returns on the DTEs, the different DTEs I've introduced to you, and different firm level characteristics, standard that we use in the asset pricing literature, and a bunch of different fixed effects, the time fixed effects, industry fixed effects, and the country fixed effects, given that this is a global data. We're going to double cluster standard errors at firm and year, and then we are going to be looking as the first kind of order of interest at these coefficients of these DTEs, try to understand how large a premium companies with different DTEs actually have in terms of their expected return differential. So this is the kind of basic result where we are regressing this next month monthly returns on the different level of DTEs. So remember, we can specify it in terms of the emissions, forecasted emissions, or the ambition score, and either you adjust by industry or not. So what you see throughout all these 6 specifications is a very kind of consistent pattern of a negative coefficient of this DTE, which essentially tells you that companies which have higher DTEs on average have lower expected returns, which is very much consistent with the story of risk. Less risky companies have lower expected returns. If you ask yourself a question, how large this effect is economically speaking, per one standard deviation of these DTEs, we are looking at the annualized return difference of about 3 to 5%. So this is actually large. If you think of papers on divestment or anything related to carbon premium, my work with Patrick, this is actually on the upper end of these numbers that people have found. So you could argue that this is economically large. And then we do a bunch of other things. And in the interest of time, I just want to show you 3 things, and then I will conclude. So the first thing I want to show you is that rather than looking at returns that you may argue are not really the best proxies for expected returns, admittedly, we could also look at valuations. So here is the exercise where rather than looking at returns, we are going to look at price multiples with the standard kind of specifications of valuation regression. So I'm showing you here the results where the left-hand side variable is the P ratio in the log scale. But we have also repeated the same exercise for market to book and the price to sales. Results are very similar. The bottom line from this regression is consistent with the return regression. So companies which have higher DTEs have higher price multiples. So basically they are less discounted relative to companies that have low DTEs, which is again very much consistent with the risk story. Important for this regression is that we also control for future cash flows through the sales growth in the future. So this is maybe a slightly better way of interpreting our results as a discount rate kind of story rather than the cash flow risk story. The second thing we have done was to kind of think about a little bit of a paradigm shift in terms of transition risk. Of course, this whole notion of transition risk has been evolving over time. People are paying more attention to climate than they used to do 10, 15 years ago. One of the defining moments that people have argued for is the Paris Agreement. So what this regression is trying to show you is how do these return regressions that I have shown to you before interact with the before versus after Paris Agreement. And the interest here should be in the interaction between all of these DTEs and Paris. And the message I want you to get out of this is that pretty much throughout all of this, all these interactions are negative, which basically tells you that the effect gets amplified following the Paris Agreement. And for most of the specifications, the results almost double. So essentially, it tells you that relative to the pre-Paris values, the premium on this DTE portfolios has increased by a factor of 2 relative to what it was pre. So that tells you that it is actually quite consistent with the story that this pressure of decarbonization has intensified, and as such, stock returns are now reflecting a higher premium rather than the lower premium for this variation in DTE. And finally, there is always a notion of how you want to implement this decarbonization in practice as an investor. Of course, you could argue that investors may not want to decarbonize their portfolios right away. They may want to wait. And then, of course, they would need to decarbonize faster. Alternatively, they may decarbonize first faster than slower. Or maybe differently, you could also think they're going to follow a just science-based decarbonization path. So what these pictures essentially are showing you is different ways in which you could, as an investor, implement the budget constraint on your portfolio in terms of the carbon. So as you can see, there is some variation in how these curves look like. All of them are consistent, by the way, with the 1.5 Celsius 83% probability scenario. And what I want to show you now is basically results that show you how robust these results are with these different budgets. The result I show you here is the one that follows the science-based decarbonization. So this is what we call the Robin Andrew decarbonization. That's the guy who basically created the scientific projections. But just keep in mind that any other curve that I have shown you just in the previous slide would give you very similar results. And what we find, again, is very consistent results relative to what you have seen before. For the left part of the panel, you see the returns. The effect on the DTE on the future returns is negative. Companies with higher DTE have lower expected returns. On the right side, you see the valuations in terms of PE ratios. And again, you see that companies with higher DTE have higher prices. So that's consistent with the kind of risk-based explanation of our results. So that brings me to the conclusion. So there are a couple of things I would like you to take away from this project. So statement number one is that it is quite actually apparent that the society is kind of waking up to this looming climate crisis. And I think for good reason. I mean, we can deny whatever is happening in the world, but I think there is more and more scientific evidence that tells us that, that actually there is some change in the way how the planet is heating, and maybe we need to do something about it. And I think as we look at more and more people globally, we see that more and more people care about it. So the question is, what is it that we can do about it? And of course, reducing emissions is the natural way to think about it. And hopefully, we as a society can put pressure on these polluters to actually decarbonize. So one way in which this pressure can be put is through this investor kind of channel. So here we propose the framework that essentially is science-based. So we are thinking of pressure that is motivated by the scientific decarbonization paths, and that allows us to create this measure of transition risk that we call distance to exit. Interestingly, this distance to exit is correlated with a lot of other measures of transition risk, and on top of that is priced in terms of the return and value differentials. And going forward, we think that more and more of this kind of initiatives is going to probably follow. So if you think of from the perspective of how large these movements are going to be and how economically significant these forces can be, we believe that this is actually something that potentially can become quite potent and quite important source of friction for companies to deal with. But let me stop here. Thank you so much. And I look forward to any other comments, questions you might have.
Oh yeah, you just on the time. Yeah, yeah. Yes. So yeah. First, would like to have any question from the audience. Yeah, if there's no, maybe I can ask the question. So first, for your first conclusion point. So from your regression results, how can you know that is from? So the companies actually got pressure from this carbon net zero funds, or just firms with a high DTE, they just happen to be performing better firms? I think that's like it's like a big question in the green finance literature, right?
Yeah,
So does the results say anything about that
absolutely.
point?
So I get from your question that this is a question about unexpected versus expected kind of returns, right? So of course, the literature in asset pricing has struggled, empirically speaking, how to measure expected returns. So in this regard, I don't think this problem is just a problem of our paper. I think what's interesting about what we show is that there is actually a kind of economic story behind what we are finding. So it's clear that these DTEs, if this story of decarbonization matters, should align with risk the way how we have kind of argued. And then given that we are looking at a bunch of different specifications, both in terms of returns and valuations, we also look at regressions with the Paris Agreement. I have not shown you that, but we also have regressions in which we control for other aspects of emissions and basically ESG. The results are not explained by those variables. So I would say holistically, it's a kind of aggregate evidence speaks in the direction of that. But of course, we cannot prove that this is just an unexpected event. But think of it that in some sense, climate is a little bit of a non-stationary effect, right? Because unlike many other things in economics that have some kind of stationary equilibrium, you can argue that over time we learn more and more about what this climate science is telling us, which was not necessarily expected. So in this regard, even on that basis, it's very hard to argue what's expected return versus what's unexpected return, right? Because climate by itself is a non-stationary kind of source of risk. So, but yeah, that criticism that you are voicing is definitely something to keep in mind. All I can bring in is that given the size of the data we take, given that we have all this consistent evidence across different specifications, it is kind of suggestive that this is consistent with the expected return kind of explanation.
I think more direct evidence maybe. Yeah, obviously I'm not sure whether you can show it or not, but more direct evidence would be if the DT is like a really viable measure, if the companies really care about the risk, the exposure to the risk, and from this financial market, if the DTEs goes down, maybe firms they're gonna put more effort to reduce the.
I see. Okay, I get now the question. So I think we are asking a very interesting question, an important question. To which extent companies are internalizing this DTE in their decarbonization efforts? So that's by itself, it's an interesting question. So notice, Sanwoo, that even with the emissions, we don't really have yet the evidence that companies necessarily are changing their decarbonization as a function of the premium. So in some sense, this is a little bit of a first stage exercise that I have shown to you here. I have shown to you that the pressure is applied, but now you are asking a second stage kind of question, which I think is equally interesting or maybe even more important, which says, do these companies respond to this pressure by changing their business? And I think this is definitely something that we should be looking at in the future project. For this project, as you can imagine already, based on what I have shown you, it will be quite a lot, but it's definitely something we should be looking at. So yeah, you are on top of that. And the only thing I want to say is that nothing in that framework guarantees that you are going to decarbonize the economy. All we are saying is that institutional investors are going to behave as if they wanted to decarbonize the portfolio. But whether that decarbonization of the portfolio translates into the decarbonization of the economy, it's not a guaranteed force. It's just companies can always not respond in the way how the institution would like them to respond. So I think that's a great question. But if I can say something, is the higher that pressure is going to be, the more likely companies will have to do something about it, right? So that's the kind of idea of that framework. It's a little bit like a tax, right? The higher is the tax you put on the company, carbon tax, whatever, the more likely it is that companies will need to respond to the economic cost that is associated with that. So that's kind of the paradigm that we have in mind, and we try to isolate here.
Actually, I just had a personally curious because you're expert on this topic. So, are there evidence up to now that firms actually respond to the financial markets?
Yeah.
By reducing
It's a great question. To be honest with you, somewhat, the evidence is almost it's tilted towards negative, meaning not so much. Okay? So let me give you a couple of examples. Okay? Example number one, in the work with Patrick, we have looked at the correlation between patenting activities of companies in terms of like green innovation and the subsequent emissions. Evidence from that, very little evidence. Basically, companies that innovate more in the green space don't necessarily decarbonize. Evidence two, I have a work with Jose Luis Pedro, my colleague from Imperial, where we look at banks. And what banks do is basically they put a force on their borrowers by limiting amount of capital to those who have higher carbon footprint. So we observe that banks are putting pressure. We don't observe that these borrowers subsequently reduce their emissions. And as far as I know, the evidence that I'm aware of has not established that link by itself is very strong. So the only thing I am familiar with is another work I have with Patrick, which is essentially looking at firm commitments. So what we found is that companies that make commitments are actually more likely to reduce their emissions in the future. But of course, you could argue that this is a little bit endogenous in a sense, you are making the commitment anticipating that you will be able to decarbonize in the future. So, but nevertheless, it is a positive sign that the more of these companies making commitments we will observe, the more likely it is a manifestation that they are actually able to do something in the future. But sadly, I think the evidence is not overwhelmingly positive, I would say, to say the least. Okay.
Okay, yeah, that's interesting now. Yeah, are there any questions from the audience? Yeah. Oh, yeah, if there's no, yeah, maybe we can wrap it up here. And thank you very much for your wonderful talk. I think we learned a lot.
Thank you so much, and everyone else for coming up and for the opportunity to present. And I look forward to more ideas and insights from you and your team.
Okay, yeah. So I'm gonna send you the link to the new Zoom. Yeah. So maybe you can make it there.
Great.
So I have a question. Sorry.
Oh, okay, yeah.
I'm Shan. So I have a question regarding our data sources. So you mentioned you're using the true cost data. So that's representing like 98 countries and like about 90% of the total market cap. I wonder, have you done any research just regarding these stocks in the Asian market? Because you know the disclosure could be quite different in just the Asian market. It is not a compulsory disclosure on the carbon, you know, so it's kind of sucks here.
No, absolutely. So let me make the following comment. The data clearly samples from a lot of global activities. So many of the markets, including the Chinese market, are represented in the data. But as you rightfully said, many of these data are actually not coming directly from companies, but are actually estimated by true cost. So that's in fact why true cost has become a name in this space. They actually created framework in which they are able to predict emissions. So let me tell you one thing I have not shown you today we have done. So the concern you may have is that all of these effects are basically driven by companies for which estimates are coming from true cost rather than from companies. And one of the results I didn't present it to you today because this is more of a data issue rather than economics issue. We found that in fact, the opposite is happening. The results are stronger for the data that is based on the corporate disclosed information rather than true cost disclosed information. So if anything, it goes against that hypothesis that the estimates are noisy and you should not, it should bias you against finding the result.
Thank you.
That's a very valid point. I agree.
Okay, yeah. I think so we can wrap it up here. Thank you again. Yeah, so much for Professor Marcin Kacperczyk.
And I will look forward to connecting.
Okay, yeah. Bye everyone.
Thank you so much.